tax versus cost and what's more important. People are often trying to find the most tax efficient vehicle based on the country where they're living, but they forget to understand the difference between tax and cost. Because the thing with tax is it can be deferred depending on the product you're in. So generally speaking, tax efficient vehicles will defer tax until you take money from the product. So that means you can buy and sell investments within the product itself, you're not incurring any taxes at all, and then the tax is based on the withdrawal that you make. So you could buy and sell investments for 10 years, pay no tax, and you're only liable to tax when you take money from the vehicle itself. The other way would be just a normal investment account where you pay tax based on what happens in that given year. So if dividends are paid out, you pay tax. If interest is paid out on bonds, you pay tax. If there's a gain within a fund or a stock or an ETF, you pay tax. So it's tax based on what you do in that given year. But with cost, there's no way to defer this. You guaranteed have to pay this on an annual basis. And the risk that you take within the investments itself can have a massive impact. Because let's just say, for example, you've got running costs in a portfolio of 2%. And by portfolio, I'm referring to the product cost, the fund costs. If you've got an advisor, those costs are all combined. So let's just say you are paying 2% per year and you're in a cautious portfolio, which is, let's say, 40% in stocks, 60% in bonds, and you're only trying to make 5% per year. Well, if you're paying 2% in fees, then you're guaranteed losing 40% of your return every single year. So that 5% is now 3%. I'm not even factoring into account inflation or the cost that you're going to pay on tax if you take money out. Now let's just say you're now in a more speculative portfolio and you're trying to make 10% per year. This 2% cost per annum is now reduced. It's now only 20% of your overall return, which leaves you with a net return of 8%. If you are deferring the tax, obviously that's a good strategy, but you really need to keep in mind the risk that you're taking within the portfolio, because tax matters on top of that as well. There are a few really simple strategies that you can do with regards to your investments. So if you're buying, for example, ETFs and index funds, and you're adopting a buy and hold strategy, you're deferring tax for as long as possible on the gains. Now you can buy two types of ETFs or funds. You've got distribution or accumulation. If you buy distribution, then things like dividends are going to get paid out into cash, which means they have to be declared on an annual basis. Whereas if it's accumulation, then all of these are accumulated within the fund, they're added into the return of the fund, and you pay tax when you decide to sell the asset. Now, what you can do, depending on the vehicle, if it isn't a tax efficient product and you just have to pay tax whenever you buy and sell investments, you can offset any losses in funds against gains, and the rules are different in every single country. But if, for example, you can't buy ETFs and funds because you're restricted based on products and nationality, and you have to buy a portfolio of just direct shares and direct bonds, then a strategy is something called tax harvesting. And tax harvesting is a bit like what I've just mentioned, where you're trying to sell whatever you can at a loss to offset the future gains. And this is a much easier strategy when buying direct stocks and direct bonds, because you have something called a 30-day wash rule. So let's just say you've tried to realise a loss buying an S&P 500 index, and you go back into that same ETF, then you actually break that rule, which means you can't offset the losses at all. But if you're going from one stock to another, that's always going to be a different company, which means this 30-day wash rule doesn't apply. So by adopting this strategy, you can often add what they call a tax alpha between 1 to 2% per annum. And you could have, for example, have made 15% in 1 year, but you've had a 2% recorded loss because only the losses have been recorded in that given year. It depends on the product and the nationality, because if, for example, you're an American, it's almost a fiduciary responsibility for money managers to do this. Rest of the world, it's not. So it's very difficult to find a fund manager that does do this. But I would say the most important takeaway from this video is costs definitely matter. Tax would come second, because there's no point paying 40% in tax based on my example, because that you're guaranteed to lose it every single year. So if you do want a breakdown of what your costs are and what they could be in different products, what we do run is a full cost benefit analysis where we break down what all of the ongoing costs are going to be, we break down what the performance is going to be and the annualised performance based on your asset allocation selection, and we really show you what is the most important. So if you do want to find out more information, please reach out to us and we can break this down for you.